Hello, this is the first week of Management 501 Foundations of Business. These short video vignettes are intended to be a brief overview of the course or not the course, but each week and the content, not to be comprehensive, but to augment the information that we would go over either online or in the few face-to-face meetings. So with that said, just the overall purpose of the course is to introduce non-undergraduate business majors to the foundations of business. What is the purpose of business, how our business is organized, the economy that they operate within, and then also a look at the functional areas that help businesses make money through creating, communicating, and delivering a message of value. Those functional areas, which we'll walk through over the next 6 weeks, would be management, human resource, HR, IT, information technology, marketing, accounting, and finance. All organizations, whether a one-person entrepreneurial sole proprietorship or a huge corporation like Apple, all have to use those and integrate those functional areas synergistically in order to make money. Those that do that really well are very successful and are what's referred to as a going concern. They go into the future indefinitely financially. Those that do a poor job or don't do it at all, many don't do a very good job of creating value to the customer, and therefore either don't make money and are no longer a business, or barely make money and have to borrow and then end up going out of business. That is the general gist of this course, is to walk through, again, the purpose of the business, the environment it operates in, and then to touch generally on each one of those functional areas, of which you'll then get courses in your MBA program on each one of those over the next 2 years or 1.5 years or 1 year, however your structure is with the MBA program. So if we go back to the original, the purpose of an organization or business, when it's all said and done, is to make money. Because if they don't make money, they can't do anything. They can't serve their customers. They can't serve a purpose if they're a nonprofit. They can't provide money for their employees to have a livelihood. They can't help if that's one of the things that they're interested in doing. So in reality, it's to make money. And we make money by selling our goods and services at an amount higher than the cost, which gives us our gross profit. We subtract out our fixed or operating expenses. That gives us our operating income. We subtract out the tax from that income that we made, and then we finally get what's referred to as net income, profit, or earnings. They're all synonyms in the business world. That number at the end, the net income, profit, earnings, mathematically is pretty easy. You're just subtracting some numbers, but in reality, it's quite difficult for organizations to actually make money because of all of the things that go into it, which we will cover again generally in this course. In terms of where it begins, and that's the value proposition, that's where many businesses and organizations fall apart. Value is what we perceive as customers, the market perceives as customers, as the exchange of what they're giving, dollars, in return for what they're getting, a product or service. We only do that if we believe that it's of greater or equal value. If it isn't, we typically would not make that transaction happen. It's the organization's job to communicate that value to the customer in a competitive marketplace. And in doing so, organizations that do really well are very focused on their purpose. They understand their purpose, and therefore they're not so price competitive. When we are price competitive, and that's all we're focused on, then what you end up doing is driving down the price, and it's a race to the bottom, and you end up making your margins, the difference between what you sell it and what it costs, almost nothing. And therefore, really, it is not even worth being in business if you can't make enough money to sustain yourself. So backing up again, the overall purpose of an organization is to make money. And in doing so, they can do good. In order to make money, they need to sell their product at a rate high enough for them to sustain themselves to cover costs and fixed expenses. The way that good organizations can do that is by communicating to the market the value relative to the competition of their good or service. And we will walk through again the next several weeks on what that looks like and how they go about doing that. Chapter 1 really is looking at a lot of economics and economic language. What we need to, big picture here, because I don't want to make this short, big picture here is for Chapter 1 is that organizations in the United States operate under a mixed capitalist society. That's an economic system, not a political system, where the factors of production, the big questions of what to produce, how to produce it, who to produce it for, at what price, is determined largely by the market. We do have some regulations, but largely the market individuals determine that by voting yes or no to those questions. In command economies, socialism and communism, the majority of those questions, what to produce, how to produce it, who to produce it for, how much, at what cost, is often determined by the command system or the government. Some socialist countries that practice a mixed version, much like ours, but are more socialist European countries, do have some market control, but they also have a lot of government regulations and ownerships and parameters on many of those questions that were just talked about. Chapter 1 also looks at the economic concept of scarcity and how an individual, microeconomics, and how a country, macroeconomics, deals with scarcity, the scarce resources, to try to be financially feasible. From a macroeconomic point of view, that's measured through largely the biggest metric and the most reported metric is gross domestic product, GDP. That's our growth rate. How much money are we making basically as a country? Our GDP currently is 1.3%, which is relatively low. Most economists would say that that's stagnant, and we have been kind of floating around that number for a number of years. And actually, in the last 10 years, we've had a pretty stagnant economy where wages have been stuck. Though we do have low inflation, we would like to see the wages inflate a bit, and that's a result of this stagnation that's occurring because of our GDP. And our GDP is stuck for a number of different reasons. That is not the point of this class. The point is to understand that organizations and businesses that are trying to make money are operating in an economy where we have a relatively stagnant economy, and therefore it is difficult for organizations to raise prices, to increase their margins, to make more money in this competitive environment where most people's wages are stuck. Chapter 2 then goes into the ethical and social responsibilities of organizations, and the big takeaway that you should be getting from the readings is that, one, there is no perfect definition for ethics. One person's ethics is viewed through a different lens than someone else's. Note that there are two philosophical lenses that you can look at it through. One is Kantianism, which is that we will do no harm to no stakeholders, and the other is utilitarianism, where the ethical lens is we'll do the most good for the most people most of the time. And so a utilitarian would likely would be okay with having t-shirts made in Indonesia for 14 cents a day and sold for $10 at TJ Maxx, where a Kantian would say, no, that's taking advantage of some stakeholder group, in this case labor, in order for another group to be advantaged and make more money. The argument would be that those shirts should be sold for $40, let's say, where those individuals would be paid a more livable and sustainable wage. I'm not saying one is right or the other is wrong. It's something that hopefully you will develop a philosophy about in the organization that you work for. How do they go about making their money? What kind of tactics do they do and implement to make their money? That is the bigger question that you need to grapple with, in Chapter 2 is introducing in this value proposition. So when an organization goes out and communicates its value relative to its price, how are they doing that? How are they doing it through distribution? How are they doing it through sourcing? How are they doing it through employment? How are they doing it through their marketing? and you have to be okay when you manage organizations, because that's why you're going to be an MBA student, is likely to manage and lead. How do you want to be a part of that in terms of your ethical lens and framework and foundation that value is built on? Viterbo likes to look at it a little bit differently perhaps than some others, in that we like something called the triple bottom line, which is of course profit, because we know that that's important, because you can't do anything without making money, but profit, people, and planet all being an equal part in the equation of this value proposition. Chapter 3 then moves on to trade and the global business, the global nature of business, and at least we can recognize, or at least think about, that all businesses really are global in nature. Even if you're a small pizza place in downtown La Crosse, likely you are global. Are you selling your pizzas across borders? No, that's not our definition of what global business is. Global business is the integration of a borderless marketplace to provide value to our customers. So if I'm a pizza place in downtown La Crosse and I have an ability to source my pizza boxes, cardboard boxes, from Mexico or from Canada or from Thailand, I would, because it's a lower cost and I can pass that savings on through value to the consumer, I am now considered a global business. And so you'd be hard pressed to find companies, any business, small or large, that is not operating on a global scale at some point in time, mostly through sourcing and distribution of their product and service. So of course there are some cases where that's not true, but by and large we need to look at it at that scale. So the question is that okay? Is it okay to source products from a different country because it's a lower cost and allows us here in the domestic country to benefit by having a price value that's more attractive and allows the company to make more money and be in business and pay their employees, and those employees then have money to give to other businesses? That's the big question, and that's the question that's of course being had in the presidential election right now through trade, because of trade we have the ability to globally compete through sourcing and of course selling to other markets if we wish. And so we look at our trade imbalance. We have a huge trade deficit in that we import more than we export. The question is that okay? I encourage you to go to the supplemental portion of Moodle and look at an article. It's a pretty short article that was written on is a trade deficit bad, and it gives both arguments. And it depends on what your lens is. If you are a customer, you likely are okay with trade deficits, because the trade deficit is occurring because we're sourcing products from other countries at a lower cost, and as a customer we benefit because we have a price that's less. If you're a manufacturer in the United States, you're probably not okay with the trade deficit because our products are harder to sell overseas, and people within our own country don't even want to buy our products because of higher costs. And so there are some that say that the trade deficit actually is just an accounting equation, and it really has no net effect. Some will say we're passing on the debt to our children. Others say no, we're not. It's just it's an accounting mechanism, and it really has no net effect, and it never will. And others say no, absolutely. It's tied to interest rates. It's tied to labor. It's tied to our lack of increase in wages and our standard of living, which you could argue that tied to GDP has not really risen in the last 10 years. All of those things are important. That is, again, not a fact. It is a perception. So I will not tell you that a trade deficit is important or not important. And again, it's something for you to dig into a little bit more, and that's the crux of Chapter 3 in terms of the globalization that's occurring in the open markets through technology that's necessary for businesses to at least recognize and how they want to put together their value proposition. It's about 14 minutes of a brief overview of those 3 chapters. We've dug into it independently in the lecture in class when we met face-to-face, but also for those online folks, we have some discussions and cases that will tie more of this together.